Hi everyone, welcome to Market Outlook Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 to 40 minutes or so. It's an absolutely jam-packed webinar, to be honest. A lot is happening in markets, of course. We will just check out how markets are trading currently, and we'll also look at last week's big mega cap tech earnings, and we'll look at some of the charts around Meta, Alphabet, Amazon, and Apple. We'll then just quickly look at last week's main risk events. There were quite a few of those. Those included, of course, non-farm payrolls, a bunch of other US data actually, and also European data, including the inflation numbers. And we'll have a quick look as well at the Bank of Japan and dollar yen as well as euro dollar, of course, attached to the European data. After that, we'll get into the meat, obviously, of the webinar, really, which is obviously this week's major events, the US election, of course, as well as a number of major central banks, the Fed, let's not forget, the same day as the Bank of England on Thursday. And we do have as well the RBA meeting, of course, overnight tonight, UK time, that is. Okay, here it is, just what we hope to get through, as I say, in the next 40 minutes, probably, looking at it. Just checking out markets currently shaping up. Really interesting over the weekend, really seeing polling sort of swing towards Harris, really, and the Democrats. The dollar is on the defensive, which comes also after, of course, Friday's weak jobs report, the non-farm payrolls report. And as I say, we're just seeing a slight reversal in Trump's odds of winning the election now in betting markets. That was the big mover in the last few weeks, which we'll get into, of course. And also we had a poll out on the weekend saying that Harris would potentially win Iowa quite easily, actually. So yeah, dollar suffering at the moment. We'll look at that in more detail on the chart. Interesting, sterling has stabilized, actually stabilized on Friday after the pretty steep run lower on the announcement of the autumn budget in the middle of last week. That is in the UK. And markets probably will be watching sort of UK fixed income markets, UK gilts. Those are the government bonds, to see whether there is any sort of more pushback with the bond market continuing possibly to revolt on that fiscal outlook in the UK. That would then spill over into sterling. Basically, if yields rise, then potentially sterling will fall, but obviously those yields rising maybe as well in the global context. So just keep an eye on those, or we certainly are, for the direction of sterling, of course, in amongst all the noise of this week. Commodities, crude actually trades near $71. OPEC Plus delays December production, which is aiming to stabilize prices actually and prevent oversupply amid demand uncertainties. We have had some Middle East tensions with a potential Iran response to Israel. And gold is actually pretty steady now, ahead of course tomorrow's elections, and really an assessment of safe haven demand, the Fed's policy outlook, which we'll get, of course, on Thursday. Interesting for us, US yields actually, they continue to climb higher, highest in months actually, highest since July, with the 10-year US Treasury yield. If I just grab that chart, actually, we don't look at it too much, but it's always important for us, as really the 10-year US Treasury yield is seen as a proxy really for global borrowing costs. So that's why we look at it, and then it determines obviously the Fed and the dollar, and of course then other assets as well. You can just see how we popped up higher on Friday there, up to 4.38% from, you can see this big move from the lows in September. That has obviously then pushed the dollar higher, and that has been essentially on the back of, well, better data, of course, non-farm payrolls previously to Fridays, of course, but in retail sales, generally. And then, of course, the Trump trade, which we'll get into shortly. But you can just see a pullback now. We've got this big dotted line here, which is a previous high going back to October 2022. You can see that high there. We've still got it in there, and then we've got some fib levels as well. And if we just go to those, you can see it is actually the halfway point of this move from those highs in November last year down to the low, the recent low in September. And the halfway point of that is around where we are. So interesting point here for yields. Equities, otherwise, I said we look into the mega caps from last week. So let me just pull up a chart, actually, firstly, of Meta, obviously Facebook, Instagram's owner. Just bear with me 1 second. I'll just pull up that chart first of all, which is here. Interesting, really, shares slipped actually following their earnings last week after the US closed. They were on Wednesday. Company forecast a spending spree in AI would accelerate in 2025 next year to really improve its advertising offering and content, which really Meta is finding challenging to monetize given the costs, the huge costs really of servers and competition with Alphabet. That was probably the key takeaway from those results. You can see Meta eventually closed lower on the Thursday when it opened after those results on Wednesday, sorry, closed down over 4% in the end. The black line there is a 21-day moving average. You can just see I think that's the all-time high. It is, of course. We did make an all-time intraday high the day before, interestingly enough, just above $600, and then obviously fell lower. The 21-day moving average, that black line, as I say, that's at 581. The all-time high then, intraday high, just above 600, 601.20 cents. We're now at 550.67.16. Just sort of closed. I think we printed an inside day after that big move down on Thursday. So you'd say support is around sort of 562. If we lose that, then we go to recent previous highs around 544, looks like. That's Meta. Alphabet, Google's owner, that beat Q3 sales expectations, helped by growth of its cloud computing business. And despite then an initial strong rally, actually the shares paired its gains the following day, really on the back of the risk-off tone, which crept in towards the end of the week. So you can just see the move then lower, really on Thursday again. Yeah, that was Alphabet. Sorry, I'm just double checking something here. And Google, of course. And then if we move on, well, you can just see the 21-day moving average there, 167. You've got the 100-day moving average. That's that grey line at 170. We're just trading above that now. Pretty mixed up chart, really, obviously, with that sell-off, move higher and then the sell-off lower back to sort of this noise. So 170 are those previous highs, really, as well, possibly support, and then below that, the 167, which is the 21-day moving average. Amazon, they reported stronger quarterly revenues driven by generative AI and advertising. AWS, huge revenue driver for them. That saw sales rise 19%. Overall revenues grew 11%. And then advertising revenue, that jumped as well, 19%. And the shares really reacted really well, up 6%. And you can see that here, up to those previous highs. Just checking, actually 201 was that previous high, and we got intraday just below there, $200.50. You can just see major resistance really around this 200 level. So it'll really be interesting. We closed just off that 197.93. You can see it's really interesting whether we can push through that previous resistance. That is Amazon. I'm just going to look at Microsoft shares as well here after their shares dropped actually 6% last week after their results, forecasting slower Azure cloud revenue growth. And then despite really a strong Q1's earnings report with revenue up 16%, the outlook is or really did dampen investor sentiment. Key points include record capex of nearly $15 billion and then significant investment in AI and data centers. Really, those two companies, Amazon and Microsoft, heavily invested in AI and cloud services, of course, driving growth, but also raising concerns really about high costs and slower growth in certain areas. That is Meta, sorry. Here's Microsoft, and you can just see the move lower on Thursday. We've just got some Fibonacci levels in here, which are from this move higher from those lows in September up to the highs in July, and you can just see we're just nestling on the 38.2 retrace at 407.65. Below that, the halfway point, which is really good support. You can see acted as really decent support in April, and again in August, that's at $389 or so. That is Microsoft. Okay, let's get on to other events from last week. Of course, US data, the Bank of Japan, and also European data, including the CPI. As we mentioned, first up, non-farm payrolls, of course. Here's a graphic really with all the main numbers updated, obviously, from our preview that we had from last week. The October report, of course, that showed payrolls increasing by just 12,000. And notably, there were downward revisions of 112,000 to the previous 2 months. That was against a consensus forecast, of course, of around 100K, which really took into account the prospect of weakness from significant strike action during the month, and then the measurement hit due to hurricane-related disruptions. Obviously, the prior, just for your guide, 254,000, but then revised lower. Unemployment, interestingly, that remained at 4.1% as expected, and then wages actually ticked up a tenth month on month to 0.4%. Essentially, well, we knew about the strikes, we knew about hurricanes. The strikes, I think we did say last week, we're going to subtract around 44K from the total, but obviously we were very much in the dark about the hurricane hit. Really regarding the I'm just checking regarding for the Fed, of course, downward revisions are significant, and really Friday's number sort of closely matches really more the survey evidence we've seen from the likes of the ISM reports and also the NFIB and also home-based reports. Remember, of course, as well, the BLS have admitted to overstating employment by a third. That was in the previous 12-month period when they looked at it, April 2023 to March 24. And there is some concern that that continues to be a sort of structural overestimation to NFPs. Again, as well, there's concerns around the quality of the jobs being added, kind of being more focused on part-time, lower-paid roles as well. There are some caveats. Probably against that would be that we're probably due to get some bounce back from this really low number just due to upward revisions, people getting or the BLS getting more data from the period and potentially as well seasonal adjustments. So a lot going on, really a very noisy report. And we've got in here, actually, we've kept in here from last time, actually, just this an inline report, which would have been 100K, would be the lowest since 2020. 12,000 is definitely that as well now. We'll update this pricing, actually, when we get to the Fed meeting, because it was a noisy report, as we say. If we just look at the chart here, you can just see that weak headline. And the 3-month average now ticking down again, having picked up slightly after that 254 print, but that was obviously revised lower. You've got the benchmark revisions in there, and obviously then this change, which is this tiny grey bar here, and obviously much lower than the previous number. Yeah, that's non-farms really, very noisy. Expect possibly some up revisions going forward, but also potentially if you take out the hits, we're not sure about the hurricane hit, as I say, but potentially it was a fair amount lower than could be expected. We shall see, and it will be very noisy. And also tough for the Fed to look through, or probably likely they will look through it for their decision on Thursday. Other data actually as well. We did get ISM services data, manufacturing data that was just an hour or so after the non-farm payroll report on Friday. That was softer, 46.5 from 47.2. The prices paid index, actually, that jumped, interestingly, to 54.8 from 48.3. That was our main takeaway, although that was probably due to one-off temporary supply disruptions. In the end, probably Friday's data didn't, as I say, change the market assessment actually that much. Really everything in place to see the Fed slow the pace of easing to 25 basis points at this week's meeting. As I say, we'll get onto that shortly. Other data just to touch upon from last week as well. We did get the Fed's favored inflation gauge, which you can see here. That's the core PCE number. And we've also got the CPI headline and core figures as well on the chart. The PCE number, that came in line with expectations, so rising 0.2% month on month, but accelerating actually from the prior 0.1%. The year on year is 2.1, pretty much in line with expectations, while the prior was actually revised up 0.1 to 2.3%. For the core metrics, more important actually for the Fed then, that saw a 0.3% rise month on month, in line with forecasts, while the prior was raised up from 0.1 to 0.2. That meant the year on year rose by 2.7%, so matching the prior pace, but slightly above analysts' forecasts. Nothing really major there in that report. Again, it's the Fed's favored inflation gauge, and really keeps us in line for another rate cut this week. Okay, also we had Eurozone data, just to touch upon the flash CPI data. That came in for the Eurozone hotter than expected, so for both the headline and the core. The headline for October came in at 2%, just 1/10 above consensus. And that increase really driven by energy inflation and food prices. A more important core number that strips out those food and energy volatility really, that came in pretty much unchanged, 2.7%, 2.68 actually the unrounded number. The prior was 2.66 and consensus expected a 2.6 number. That increase really driven by services prices, with goods prices unchanged. Generally, though, the release sort of mimics the picture we've seen in the previous recent months, except for September, really of underlying inflation slowly moving lower amid a still sort of elevated services price pressure, but clearly absent goods price inflation. It shows probably that the soft data we saw in September was only a blip. Really, momentum in inflation is still heading in the right direction for the ECB, just not as fast as the September data suggested. And Friday's data really supports the case probably for a 25 basis point cut by the ECB in December, really against a jumbo cut of 50 basis points. I've just put in here actually the pricing is just over 25 basis points. You can see 30 basis points or so. So that's just a 20% chance of a 50 basis point cut. So much more likely is a 25 basis point cut in December. Okay, we'll just look at euro dollar actually now. Just let me pull up the chart. Which is here. And you can just see us pick up, sort of finding a base just around 108, just below 108 from the October lows. That was at 107.60. We're just picking up from that. We just moved above the 21-day moving average now, that black line. And we're just now really interesting the Fibonacci here. You can see the halfway point of this move higher from the April lows up to sort of 112 level. That halfway point is at 109, 109.03. So we're just up to that now. And then the next fib level, 109.74. And you've got the 100-day moving average at 109.38. Obviously, big support around sort of 108, just below there, with that fib level at 108.32. That is euro dollar. Obviously, potential big moves this week on, of course, the election and the Fed meeting. Just before we get to that and the election, let's just look at dollar yen. Of course, we had the Bank of Japan meeting. Where the BOJ kept rates unchanged as expected. Really, they stressed really their intention. Probably this was the most important takeaway, to keep hiking borrowing costs if the economy sustains a moderate recovery. Updated growth and inflation forecasts actually barely changed compared with the July update. And really then the bank is probably preferring a sort of wait and see approach ahead of course, the election this week. And until the political situation in Japan, of course, after the recent election, after the ruling coalition lost, of course, its majority, just to see whether that or when the political domestic situation becomes more certain. I think most BOJ watchers, they do expect another hike in December, particularly because the BOJ might see it as necessary to support the yen. And with inflation and consumers' purchasing power heading slowly in the right direction, there is also an economic sound case for it, irrespective of the yen. We're just seeing, obviously, now the major turn lower. I've got a load of Fibonacci's in here, but they're long-term ones. And then the near-term ones, you can just see probably the halfway point of this move lower. That's at 150.76, tallies with the 21-day moving average just above that, and the 100-day just below that. You can see 150.80, 150.34. That potentially offers some support to dollar yen. This very highly correlates, of course, with 10-year Treasury yields. We've shown you that previously. So if we just grab that chart, which I can do again, which is here, you can see those pushing higher and that pushing dollar yen higher. If I just go back to dollar yen, of course, then 150.76 around that area would be decent support, and then you've got resistance around sort of 153.40, the next fib level, and those recent highs. Okay, let's get on to the US election now, finally. Obviously, had the 5th of November. You'll probably, like me, circle massively in the calendar as the big risk event, probably of the year, really, certainly of this month and going forward. A lot to say, really. We've said a lot already in the last couple of weeks. If we just move on, firstly, that's quite bright, but hopefully you can get a picture of what we're getting at here. We've got one for if Trump essentially wins, although he might be slightly handicapped if the Democrats win the Senate. And then we've got a Harris one as well. And we're just trying to break down each asset class, really, and the sort of wider picture. We also do have a chart as well, which I put in last week, just showing you how the S&P returns, or how the S&P performs better under a unified government than, of course, a divided government. We'll get to that shortly, but just before or while I let you look at these different infographics, really interesting at the moment. Weekend polls, well, they upended slightly things as Harris is coming to view really on betting markets. That sort of narrowing has occurred. And really that kicked off the Trump trade that we've seen over the last few weeks, where betting markets basically had a handful of really big bets on Trump winning, and that pushed the odds from sort of 50-50-ish out to sort of 64. 36 in favor of Trump. That's percentage wise. That's how betting markets work. They get swayed by potentially big bets. That has now narrowed actually over the weekend. And also we've seen some polls, as I say, more in favor of Harris. We had, as I say, that NYT Seltzer poll, which has Harris winning in Iowa and potentially elsewhere as well. It's a very volatile and mixed up situation, really. Swing state polls kind of much closer, of course. They had Donald Trump edging slightly towards him last week, actually. That said, they're all within the margin of error. That is probably key because while betting markets, as I say, sort of blew out slightly towards Trump, and then financial markets reacted to that in the last few weeks, then polling, though, has been fairly stable, fairly neck and neck. Although, as I say, swing state polls slightly edging towards Trump in the last week or so. Of course, turnout will be key, and polls, of course, have been wrong before. If we kind of assume Harris secures, say, all the blue lock lean states, that's 226 electoral college votes. She needs 270. And then if she wins Michigan, Wisconsin, and Pennsylvania, those are three of course, the 7 key swing states. That would actually be exactly enough to get to 270 votes and get elected. Donald Trump, he is ahead, as I say, in actually, well, depending on who you look, potentially all swing states except Michigan and Wisconsin, but by less than 0.5% in Nevada and Pennsylvania. Remember, Pennsylvania, whoever wins that generally would win the election, and that has 19 electoral votes, which is really huge. That's just a sort of polling situation at the moment. Regarding results, well, a clear-cut victory for either candidate could easily see the result announced on election day itself or within hours of it. Probably not what most people expect, really. If the result isn't easily determined from in-person votes, then we'll have to wait on the mail-in ballots, which inevitably take longer to tally up. Essentially, most swing states don't actually start counting those until election day. And this method of voting is more widespread than in years gone by. If you then add in, say, potential for recounts in the crucial swing states and maybe some legal delays, then really it's easy to see how, we could take several days or even weeks for us to get a kind of clear sense of what's happened. Just for your guide, of course, it took 4 days for essentially the networks to confirm Biden as president back in 2020. Some people referring, of course, as well to the result in 2000, where Florida had a big recount, if you remember at all. And that then, even though the Democrats actually gracefully conceded, that took around a month, 4 weeks or so, for that to be called officially. A lot of uncertainty with that. It would be much easier, as I say, to really see a clear-cut victor, and potentially then you might not see many legal sort of wrangling and delays because of that result. Markets then, as I say, have been pricing in a Trump victory in recent weeks. You can see here what we think, but a lot of this has happened already. Let's remember that. But just to run over that again, the possibility of extended or expanded tax cuts coupled with tariffs is widely assumed to mean higher inflation. That means a stronger dollar and higher yields on a Trump victory. Of course, if there's a period of time without a clear result, just to touch upon that, then of course some of that Trump positioning that we're seeing, of course, now as well, that could start to unwind as the chances of a Harris victory are reassessed. Is kind of what we're seeing today with the dollar selling off, yields coming lower, potentially then as well, the dollar would sell off a lot more sharply on a Harris win, of course, than with a Republican sweep, possibly pushing dollar higher, but then less on how much a Harris win hits the dollar. If the Democrats secure the House, then again, watch out for that, because the dollar might struggle to rally if Trump wins the presidency. But certainly the most dollar or the bullish scenario for the dollar would be a red sweep. But then watch out, because we've had this big move already. And then if we get a split Congress, that could not see the dollar rally so much going forward. Of course, it's neck and neck, so do expect some volatility. That's sort of Trump's outlook, and hopefully that's clear to you here. Although, again, I stress we have had a lot of this move already. And I know one investment bank, I think it was Citigroup, expecting a sort of rumor fact type move, even on a Trump sort of win, especially if it's not a red sweep, then you could just see this sort of exuberance pull back slightly. As for Harris, you can just see it's kind of the opposite in a way. The dollar will go lower, really, on tighter fiscal policies and then looser monetary policies. That's not seen as being so inflationary. And then obviously we get a less aggressive trade policy, which potentially is dollar negative. Interestingly, at the moment, I was just checking markets actually, and the biggest move is in dollar Mexican, that's the peso, and that is seeing, essentially the dollar Mexican lower, so the Mexican peso is outperforming, and that is the strongest currency that we're looking at today. Otherwise, dollar yen, that's moving lower, that's to be expected. And then dollar CNH is an interesting one as well, not moving so much lower as, say, the Mexican peso, but also down, with as well cable just coming back, actually slightly, was down 0.5% or so. Sterling against the dollar, up 0.5% or so, with the dollar weakening. Hopefully that is clear. Please do, I should have said at the top of the webinar, do ask any questions about this in the chat box if you do have any. But that is how we're sort of reading the election at the moment. As I say, a lot of uncertainty. Is neck and neck, really, in some of these key races. So expect volatility for sure around the timings of the results and sort of going forward as well. We have got that chart, as I just showed you earlier, just for the S&P 500, and yes, the preference for a unified government, certainly, and even a Democrat one just sort of sneaks it with the biggest gains after that, if we do get a unified Democrat government, which was slightly unlikely, or was unlikely at the moment, although I know people are turning over the weekend slightly towards that, interestingly enough. But a divided government would potentially mean less stock market gains going forward. Okay, otherwise, we do have the Fed meeting on Thursday and the Bank of England meeting. Again, a graphic just with the main numbers. Widely expected the Fed to cut rates by 25 basis points. Consensus almost unanimous, basically. We have mentioned it before, actually, that the Fed usually delivers what the dot plot says it will deliver for the current year when it is delivered relatively late in the year. And if we think back to that September summary of economic projections, the explicit guidance pointed towards another 50 basis points of cuts in total for the November and December meetings. And the in-year dots, as I've said, usually perform very well. So yeah, 25 basis points expected this time and in December as well. Chair Powell very likely to say, well, the data is noisy, but that the broad trends point towards a gradual kind of rebalancing of pressures on aggregate supply and demand at the margin. In terms of the kind of dual mandate variables, then Powell again likely to continue to cite progress towards lower inflation, with that PCE at 2.1% now, core PCE at 2.7%, but drifting lower. And then you can still probably argue that payrolls are growing at a generally somewhat cooler pace so far this year, around sort of 170K. versus sort of 250k over the same period last year. And then, well, will he get questioned about obviously the recent 12,000 payrolls print? He'll probably, as I say, potentially look through that as saying it is very noisy and they want to see more data to then consider their position. But in the meantime, of course, he won't know. He will know, or hopefully he'll know the results of the election 48 hours later or so. Whether he does or doesn't, he probably won't say too much about it, of course, and about what the outcome could be. He'll probably indicate a willingness to work with whatever administration, while of course then focusing squarely upon the dual mandate set by Congress, and monitoring policy developments, data and markets going forward. Essentially, he can't opine on the macro economic effects of potential policies because, of course, he probably won't know them, and then he will tend to stay in his lane, really leaving fiscal policy to elected officials. So those are the numbers, and you can just see we've got that pricing in there actually now. There's around 45, 46 basis points of cuts priced in for those two meetings. So I've flipped it on its head actually, and there's only an 18% chance, small percent chance of a pause in December, much more likely 82% or so likely to get another cut in December, as well as of course this one on Thursday. That is just the chart of where rates are expected to go. Forecasts then going forward for this year, pretty much nailed on for those two cuts. I'll just pull up the DXY chart now, actually, which is the dollar index chart. I always say this when we look at this, but it is heavily skewed towards the euro. 56% or so of a weighting with the 6 other trading partners of the US. So you can just see now, interestingly, we did point out euro dollar, so that's a sort of mirror image. So you can just see the sort of 112 level here tallies with this sort of dotted line of 161. So strong support there. You're just tapping now the 21-day moving average at 103.62. And then we've got in these sort of minor fib levels here. So the halfway point of this move lower is at 103.33. And then upside is capped by these recent highs around sort of 104.60 or so. You can just see pretty big move lower now, taking out last week's low. And we're just tapping that 21-day moving average. As I say, heavily skewed towards the euro with the weighting, but just interesting now, possibly we're rolling over with this reversal of some of these moves, this move that we've seen higher in the recent weeks. Okay, also we have the Bank of England as well. Here's an infographic and a preview. Of course, again, or similarly, widely expected to cut rates by 25 basis points after a pause. I think there's around 22 basis points or so priced in, so pretty much nailed on. That has come lower, actually it's around 20 basis points, actually come lower since the UK budget from last week. Markets really will be interested in hearing what the MPC has to say about certainly the budget and also then the monetary policy report. You've got to think, while the Office for Budget Responsibility, that is the office that comments on the government's moves, while the OBR, that is, they see the announced fiscal measures are both pro-growth and inflationary. Possibly it may not significantly alter the Bank of England's view. Really, for now, Andrew Bailey, the governor, he'll focus on probably this decent drop lower in services inflation. We always say that is a key number for them. Core inflation, of course, but also service inflation, that dropped below 5% recently. And then that would really drive the attention away from the budget and back to data. Bailey, he said recently actually that disinflation is happening faster than we expected it to. And then also Chief Economist Pill, he said he placed emphasis emphasis, sorry, on incoming inflation data, and that most recent data saw the core fall by more than expected to 3.2%, from 3.6% and estimated 3.4%. I've got the headline in there, but that was the core number. All in all, that could be read then as a dovish signal for the Bank of England rate expectations. There is probably room for more easing added to the sterling curve, if you like. I've got it in here. There's around a 28% chance of a 25 basis point cut in December only. So possibly if the Bank of England is more dovish, then certainly that will increase. But as we say, the budget is a sort of interesting topic. Whether they address it or not, of course, will be interesting, as I say, of note for sterling, because, as I say, the OBR say it is relatively pro-growth and inflationary, and that's why we have seen some rate cuts priced out in the UK going forward. If we just pull up the cable chart actually now. Yeah, sorry, and we just got a question here about the oil price, which I will pull up a chart now actually, so bear with me 1 second. Let me just find Brent crude, which is here. And just bear with me 1 second, because I'm just going to double check that chart first of all. So just give me 1 second, because I'm really keen to answer questions for sure. I just want to double check that chart first of all. So just bear with me 1 second. Yeah, give me 1 sec. And I just want to double check this chart, crude chart, which is up 3% or so on those geopolitical issues, as I say. But just give me 1 second. Sorry, bear with me 1 sec. Yeah, apologies, and I appreciate you holding there. Here we go. Here's the Brent crude chart. Yeah, and just a question on oil. Just bear with me 1 second again. Apologies. Yeah, so here's a crude chart. Thanks for waiting and being so patient. Generally, you can just see, well, technically, if we just look at technicals here, and I've got this long-term low at 70 bucks or so from this low in March last year. We did pierce that sort of low, but again, it's sort of really decent support you can see on numerous occasions in the last few weeks or so. So that's a huge level, 70 bucks or so, let's call it. You've got the 21-day moving average here, which is at 74.93. If we do break up to the upside, then potentially you've got the next major fib level really of this move down, which is at 78.75. And then you've got the 100-day moving average, which sort of capped that upside pretty much in October. That's at 78.11. So if we do break up towards sort of through 75 bucks or so, then potentially we get up to 78 and beyond. As for the election, as for the election, I guess Harris really potentially, if there's lower growth prospects in store compared to say Trump, then potentially oil takes a hit or goes lower slightly. Even then, if we get Middle East tensions persisting, that may be an issue, of course. And again, as well, it's sort of geopolitical issues around Russia, Ukraine. If there's no deal there as well, potentially, then that pushes oil higher. That possibly is under a sort of Harris scenario. For a Trump scenario, an oil tax cuts, you would think would be beneficial to oil. And whether there is then, of course, this increasing dependence, I guess, on US energy independence, then potentially that doesn't help oil as much. And also then you may have increased pressure on OPEC plus, sorry, to increase production. And again, potentially that pushes oil a touch lower. So that's sort of Trump versus Harris and oil prospects on the election. Hopefully that answers your question. And if you do have another one, please do ask it away. That is the chart there. Let me just move on to the Bank of England meeting. As I said, a 25 basis point cut is priced in pretty much. We have had those comments from Pill and Bailey, and potentially will be of interest. Obviously, the budget being slightly inflationary and then pulling back on those rate cuts. I was going to look at cable actually, so just bear with me. That's what, just pull up that chart. Sterling against the dollar, of course. 130 has been a sort of big level for us. We've highlighted that in our daily commentaries, actually, when we've covered cable. And you can just see we're hovering around this now. We've got the halfway point of this up move from the April low up to the September highs, that halfway point, which we tapped actually and then bounced off. That's at 128.62. You've got the 100-day and the 21-day moving average around 130 again. So sort of big pivot point, really. If we can break higher through 130, then 130.42 initial resistance, possibly up to sort of then 131 and above. Otherwise, 128.62 sort of key level, which maps that end of October low. Finally, let's just quickly move on. Sorry, we're 48 minutes or so, but we'll quickly move on to the RBA. Nothing too much expected actually from them. No change to the 4.35 policy rate. Governor Bullock, she recently reiterated actually that inflation will take another year or two actually before it's sustainably back to the 2 to 3% inflation target range. Latest core inflation gauges, that's the core, remember, remain above the upper bound actually of that target range, averaging around 3.6%. Kind of means should be some support for the Aussie really on this sort of more hawkish RBA compared to other central banks. Of course, the Aussie is governed by broader risk sentiment and as well the dollar and certainly the tariffs and China tariffs being a huge driver of markets in Asia, and of course then also the Aussie as well, and that's why we've seen this big sell-off in the Aussie dollar with dollar strength, of course, and potentially that Trump trade and tariffs coming in. Slight reversal now, so we've got a sort of base around possibly 65.74 or so. You can see there. Next level of interest really 66.44. That's the halfway point of this August move higher. And yeah, the 61.8 is sort of 65.74 as well. So big support there, you would think. Okay, thank you so much for staying with me for so long, 50 minutes or so. Really do appreciate you hanging about. Of course, hopefully that's been of use to you guys. Yeah, what can I say? Really huge 48 hours coming up or so with the central bank meetings, of course, and as well the election. Do please follow us on social media. We'll be commenting on the election going forward. We just had a trade bid or so, I think, went out just with this slight change we've seen over the weekend and this reversal of some of the Trump trade, at least. We'll be commenting on the election as we see it after Tuesday, actually, if there is a result, of course. We'll have an in-depth article as well, very closely put out after or if we do get that result as well, and as well then looking at all the different asset classes and what we expect to happen. Yeah, do follow us on social media. Just checking in the Q&A again. Yeah, really do appreciate your thanks there. And we will have the next webinar actually same time next Monday. So we'll review, of course, the central bank meetings and hopefully the results if we do get one. If we don't, then we'll just give you our thoughts on what we expect to happen, of course, going forward. Exciting times ahead for trading. Expect volatility though, of course, so do keep risk management of your positions, position sizes, stops, etc. Do keep an eye on those because we do expect volatility. Good luck, and we will speak to you very soon.